Good afternoon and welcome. I'm Dean Miller, the President and CEO of PACT, and we want to welcome you to our webinar, the P5M method for value creation. You're going to learn all about it in the next hour. We're really excited to present one of our closest allies and supporters, Fairmount Partners, who is sponsoring and leading this session. Again, this is a webinar. You're going to get a lot out of this. We are recording it so that we can share it after the fact. And as a webinar, you are all muted, but we still ask you to ask questions. Use the comments box. We'll monitor it throughout, make sure that we respond to the questions. This is planned to go till about 2 o'clock, but feel free to ask questions throughout. Without further ado, I want to introduce Director of Technology Investment Banking at Fairmount Partners, a very close friend of PACT's, Alan Bourne. Alan has served in many roles. He serves on the board of PACT. He has been previous chair of the Forum Enterprise Technology Conference. Quick plug, that Forum conference is back in person this year, April 27th at Penn State Great Valley. You can go to our website, philadelphiapact.com, to get your tickets. It's going to be a fabulous event with great speakers coming physically from all over the country. Again, April 27th. And then Alan and Fairmount have been incredible supporters of that, as well as our Enterprise Awards, which is again in person at Springfield Country Club on May 24th. So two things again to plug, but there's tons of upcoming events, that you're just not going to want to miss. With that, let me turn it over to Alan.
Thank you, Dean. Appreciate it. And let's see, Megan, if you could stop sharing your screen, then I will go ahead and share mine. And we should be good at that point. All right. Thanks, everybody. It is great to have you here. Really appreciate it. So Roger and I are with Fairmount Partners. We're going to talk about what we call P5M, which is a value creation framework that we use with emerging growth technology companies. And it's great to see everybody. So just a little background here. Fairmount Partners, many of you know us. We're very active in the community, very active in the technology community. We are an independent technology-focused investment bank. We were originally part of PMG, one of 3 top worldwide leaders in emerging growth technology public offerings. We later spun out of Investec, and we've been an independent firm since 2004. A couple of things about our founders and the folks who run Fairmount Partners. So the principals of Fairmount have backgrounds of successful entrepreneurs. We have built companies, we've run companies, we've taken companies public. And so we've been in the operator's seat, been in the CEO's seat, and what we've done is sort of taken those experience and developed a passion for working with entrepreneurs. What we're going to talk about today is some proven methodologies that we have around process and optimizing positioning, and we have very extensive technology and software expertise. We focus on, from a horizontal perspective, SaaS, IoT, industrial IoT, data analytics, and then we apply that to vertically focused software as well. So I'm Alan Bourne. I'm a director with the technology practice. A little bit about my background. Started in technology in the early days of the internet. Back in 1995, I think I joined an ISP. Ended up going back to grad school and came out as a technology investment banker focused on M&A and taking technology companies public. I've been with Fairmount for about 10 years now. So Roger, why don't you go ahead and introduce yourself?
Yeah, absolutely. Thanks, Alan. And thanks for everyone who's joined us. My name is Roger Christopher. I'm a director in Fairmount's technology practice. Been with the firm for about 8 years. Prior to that, I actually met and worked with Alan at another investment bank in my prior life, and also have a technology consulting background with the likes of Accenture and a couple of big four firms. So excited to be here today and share our methodologies for driving value.
Yep, thanks, Roger. And a couple of notes. So we're going to try and save some time at the end for questions. However, if you do have questions, there's a couple of ways to post them. One is you can post them through the chat. Another way is that you can post them through Q&A. But regardless, we'll try and monitor those and answer any questions that you might have. Also, I will add that for those of you who are interested in getting this deck post webinar, just reach out to us. We'd be happy to share it. And again, this is something that we're really proud of, and something that we utilize to work with emerging growth technology companies, and wanted to share it with the community. All right, let me move on here. All right, so how did P5M evolve? And P5M, again, is a framework that we use to position and value companies, right? So P5M evolved, it's been 30 years in the making, and it really comes out of our experience with thousands and thousands of emerging growth technology companies. And essentially what we've learned and what we've reversed engineered is what drives value, what makes a successful company, what makes a company that buyers are interested in. And we've taken all those learnings, basically analyzing the companies that we work with and the deals that we see in the market. We came up with this methodology that we use as a framework to work with companies to think about what can you do to position your company for an investment, or for a sale, or really just for successful, successful growth. All right, so what are the use cases of P5M? So a couple of things. So one is what I just mentioned, positioning companies for growth. Another is to determine whether and at what level to fund strategic initiatives. So where should we be deploying capital? Another is to reach consensus among disparate stakeholders regarding a forward strategy. And a good example of that is a SaaS company that we worked with. We were brought in by a family office that was trying to determine, do I invest in it or do I just sell it? And what we identified based on the work was, hey, you got a really interesting market, you've got a strong management team, you've got a great opportunity if you do these things. And they invested in it, and they've tripled the ARR. So these have pretty positive impacts. And another thing is position for optimum valuation and transactions. And we do a lot of work with our clients prior to getting into market, right? Prior to taking a company with market. And what we'll do as part of our analysis is identify areas that you're strong, areas that require improvement. If an area requires improvement, how do you go about improving it? And so we're using this for positioning for optimum value and transactions. And we've got a couple of recent case studies where it's worked out. One is we were involved in the sale of AGI to Ansys. That was at the end of 2000. And then Roger, you want to talk just briefly about the deal that you closed last year with Pinnacle 21?
Yeah, absolutely. So we closed a transaction with Pinnacle 21 with a publicly traded company called Certara. This was a client with whom we used the P5M process specifically to dramatically optimize and maximize our valuation. This was a deal that was done at $310 million, and arguably, without this process, easily this could have been a transaction that could have occurred at least half that, right? So certainly the P5M process was very, very valuable in getting that result, a happy result for our client.
Yep, absolutely. So that's how we use P5M. That's how we think about P5M with our customers. One thing, there's obviously a lot of venture-backed companies in the Philadelphia area and involved with PACT. Just something to mention that we think is interesting. So valuation for early stage companies, it's driven by the elements of the P5M, but it's also driven by company stage, right? And so how do VCs value businesses? It's really all around IRR and risk. And then depending on company stage, their return targets or multiple of invested capital can be 4 to 10x over a 5-year period. But we also thought it would be helpful to sort of think about how stages are, how we think about stages for early stage companies. So seed stage, it's concept and initial business plan. For a Series A company, these are typically looking at de-risking their product, demonstrating a minimally viable product and customer uptake, and developing a business plan. Series B, de-risk scaling, and then building the initial sales and marketing infrastructure, and then validating that. And then Series C, scaling, sales and marketing. So just a little bit of information about how we see the stages of companies and also how VCs look at valuation. All right, so SaaS companies. What are the core factors that influence SaaS valuation multiples? And we use SaaS valuation multiples as a proxy for emerging growth technology companies, because so many emerging growth technology companies are now they utilize a SaaS go-to-market, and so we find that that valuations around SaaS companies are a pretty good proxy. So these metrics are typically utilized to measure success of recurring revenue business model. So what are the big things that drive valuation here? So it's ARR growth and scale, Rule of 40, which we'll talk about in a little bit, gross margins, the addressable market and moat, revenue retention, customer acquisition cost ratio, lifetime value to customer acquisition costs, and CAC payback. Right. So these metrics are what we do is we live them, we breathe them, and we encourage our clients to do so as well. And what you're able to do, and what buyers are able to do, and what venture guys are able to do, is they're measuring you against these benchmarks, and the companies that are Rule of 40, very, very fast growers, and those with top quartile metrics are receiving premium valuations. So a little bit of background on what drives SaaS multiples. So what's Rule of 40? Most of you know this. I won't spend a ton of time on this, but Rule of 40 is growth rates of 40% or higher, and that includes EBITDA margin and growth rate. But I will tell you that for smaller companies, growth is really the key factor, right? Are you growing at greater than 40% a year? And that's so this is something that we use. It's important to it's important to remember, right? The unique TAM, total addressable market opportunity, is important, maintainable moat, and the threshold of Rule of 40 really typically applies to companies that are in excess of $10 million in ARR. Again, happy to answer questions on this. If folks want to learn more, you feel free to reach out to us after the webinar. All right, so I'm gonna turn it over to Roger for a couple of minutes to talk about what a premium valuation looks like before we dive into the P5M.
Sure, thanks, Alan. So the next few slides, wanted to give the audience some insights into, when we say premium valuations, what does it look like in practice? So we track a publicly traded index of well over 100 companies in our SaaS index. And what we're seeing on this page is the tracking of valuations, over time. So you'll notice there's been a significant amount of volatility lately, in particular with concerns about geopolitics in Ukraine, inflation worries, etc. But what you'll note to the right-hand side are where the median valuation multiples of our SaaS index have trended. And you'll see the peak occurred really in late 2020, Q3, Q4 of 2020, where the median enterprise values to revenues peaked at around 15 to 15.8 times. It kind of held those levels until really late last year, where again, concerns with inflationary pressures and then most recently the broader geopolitical situation has really resulted in a reversion to the means. That being said, the median valuation multiples, the most recent numbers that we have here, SaaS companies are still trading at very, very healthy multiples, right? At median numbers of 8.1 times. The more important point as it relates to the rule of 40 constructs that Alan just mentioned is, if you take a look at the subset of companies within our index that are rule of 40 companies, meaning the combination of their growth rate and EBITDA margins are in excess of 40%. The valuations for those companies are significantly higher than the broader index, and the valuation for those companies are 17.2 times. So achieving a premium valuation is highly, highly correlated to being a rule of 40 profile company as a SaaS company. Next slide. In addition to tracking public companies, we also track an M&A database of transactions. And what you'll notice again here, again, pretty healthy multiples, pretty stable and healthy median multiples for SaaS companies, hovering around 6 times a revenue as of our most recent data. Again, as with the publicly traded databases, we actually analyze our M&A databases in terms of quartiles, and there's a huge difference between top quartile companies and the bottom quartile companies, and a lot of that has to with a lot of the top quartile companies exhibit the types of characteristics that we effect and optimize through our P5M process. So in terms of our within the 6.2 times revenues, there's a broad range of and top quartile companies are routinely getting double-digit revenue multiples, as I'll kind of highlight on the next couple of slides here.
And one thing to add, and you can see the top quartile multiples, or the multiples for top quartile companies. Lightspeed, which is a big acquirer, they bought a company for 26 times. Intuit bought MailChimp for 15 times. Thoma Bravo bought Medallia for 13 times. So really strong SaaS multiples that are happening out there. And one point to add, so as Roger mentioned, 6.2 is median revenue multiple. And we had looked at the public companies, the median was 8 times. The average is more like 11 times. And you can say, gosh, valuations have come down so much. But for a public company, they are looking at how do we make a deal accretive? Well, one way to make a deal accretive is that if I'm trading at it for 11 times revenue and I buy a company for 6 or 7 or 8 or 9 times revenue, it's still an accretive deal for me, right? So even though multiples have come down, the public buyers are still able to pay quite a bit for SaaS companies, and there's still a healthy market for SaaS companies out there.
Yeah, thanks, Alan. So here's some quartile analyses from our SaaS M&A database. I'm going to hone right in at the top, right? So second and first quartiles. These are the companies with premium valuations. You'll note a relative consistency and actually even growth in the median valuations within the top quartiles since 2020 and through current data. The important construct here is the following. So how is it there are SaaS companies that are getting 1x revenues, and there are others who are getting 20 times revenues? And a lot of that is going to be what Alan will talk about later in our, in terms of the elements of our P5M process. But it should be noted, the math could be done after the fact, right? So in a lot of these companies, buyer organizations, it's not that someone inherently looks at a company and says, hey, we're going to pay 10 times revenues. The exercise that happens internally at these buyer organizations, whether it be financial equity companies or financial private equity companies or strategic buyers, they do an analysis of what can this target that we're looking to acquire, what can that company look like in the future, 3 to 5 years down the road? And what they do is, if to the extent that there's a credible model that's put together and the total addressable market is large enough where they believe that with reasonable certainty, we could create a $50 to $100 million revenue business over the next 3 to 5 years. What they then do is they value that business into the future and present value it to today's numbers. And in the end, you could all do the math and impute these revenue multiples that we show here. But that's really what happens in the hallways, which is why preparing companies with the P5M methodologies that we have, it really arms these buyer organizations with the ammunition that they need to sell internally in their organizations and drive towards premium valuations for the right assets. So I just wanted to point that out before moving on to the next slides.
That's right. Thanks, Roger. And so when we as sell-side M&A advisors, which is what Fairmount does, I think 70% of our business, 75% of our business is sell-side M&A. On the technology side, on the industrial side, and on some of these more mainstream businesses, these things are being driven off of EBITDA multiple, right? And how do you sell a company that's doing $20 million in revenue for $300 million when it doesn't have EBITDA? Well, what we do is we focus buyers exactly on what Roger just talked about, which is, hey, if you're thinking about what multiple to put on this, and you're talking to me in terms of multiples and valuation in terms of multiples, you're not thinking about it the right way. The way that you really need to think about this, and a lot of it's just a negotiating game, right? But the way that you really need to think about it is, what can this business do on your platform? Because we have some pretty good ideas about that, and that's driving our view on valuation. And that's sort of how you try and get somebody off a multiple and onto, hey, what's the value of this company to you? That's how you ought to think about valuation. That's what's going to win the day. Don't tell me that it's a 4 times revenue business, because you're looking at it the wrong way from the beginning. So that's just something that we do with buyers to sort of get them to think about, the asset and not what's happening in the market. All right, so diving into the framework. So P5M, we got 5 Ps and we got 5 Ms. And we'll go through each of these in a little bit more detail on the next few slides. But on the P side, you got the problem definition, product position, price, and persona, buyer persona. On the M side, you got market, momentum, management, and model. And so I'm going to dive into these a little, just to spend a couple minutes on each of them. All right, so when you think about the problem, let me just go back to this for a second. What we try and get, what we do when we're using P5M is we're thinking about and analyzing companies with these different aspects in mind, right? What are they doing that's unique? How is their product solving problems? What is their technology moat? How big is the market, right? And so this is how, each of these sort of stands alone, but the aggregate of this in terms of how do you score yourself? How do we score you? How do working together we score you on the aggregate of each of these different angles is really how we're using this to think about positioning, to think about investing, to work with boards, and to, to try and create strategic value. So hopefully that makes sense. All right. So now diving into the P's. So on the problem, what's changed? What makes it possible and important to create something new, to create something game changing? And so when you see these bullets on the right, so these are the analyses that we do, right? So what's the problem? What's the need definition? What's the market opportunity definition? What was the state of the industry prior? And what's sort of the outcome or a positive outcome? Well, in the blue box here, our result, if somebody is sort of scores well on the problem definition, the company's identified an important problem as well as the means to address it in a differentiated way. On the product side, so what's the product? What's the company delivering? Is it new, unique? Is it next generation? And again, we're looking for companies that offer unique products that address emerging customer needs and key pain points. On the positioning side, so what makes the company different? What makes the products different, particularly as it relates to its competitive set, right? So I used to work in sort of B2C internet back at my old firm. We'd work in B2C internet, and the question that we would always ask about positioning was, for internet retailers, how's Amazon going to put you out of business, right? And so the idea here is, are you uniquely positioned, and do you have an opportunity to dominate an emerging market segment? Because balls.com, golfballs.com is not uniquely positioned relative to Amazon. So on pricing, we look at pricing as a means to evaluate and estimate a total addressable market, or a bottoms-up total addressable market, which we'll talk about in a little bit. But it's really understanding what's the methodology, what's the model. Ideally, it's recurring revenue versus reoccurring revenue, and then what's the ROI analysis with a focus on showing magnitude of return that moves the needle for customers. And again, with what we're looking for here is a pricing strategy that provides customers with a compelling ROI while enabling the company to scale effectively. And a couple of little sassy points here, customer annual contract value, customer lifetime value. These are the types of things that we measure to benchmark companies against other companies that are they're similar size, similar focus, that type of thing. And it's what investors and buyers are looking at too. So persona, who is the customer within an organization, and does the customer have a budget, right? Who are you selling to? Are you selling into the C-suite, or are you selling to somebody who's in the marketing department, right? The higher up you are from an organizational perspective, the more meaningful you have an opportunity to be. If you're selling to the CFO and are demonstrating, or the head of, or the chief marketing officer, or somebody at a senior level, then you have the potential to have a more meaningful product, and be, when you're selling that high, you can also demonstrate stronger utility and strong, be able to create an opportunity for stronger retention, which is again something that we look for. So that was the last P. 5 P's. The moat. So moat's really important. What are the elements that are going to put you ahead and keep the company ahead of the competition? So what are the current competitive barriers? We do an intellectual property review. What's your R&D roadmap look like? And what we're looking for is a company with a strong competitive moat, strong competitive barriers today, and a roadmap that's going to maintain those barriers for the foreseeable future. Because emerging growth technology companies, one of the issues that they face is marginalization and commoditization for those if there are well-capitalized competitors out there and all they need to do is pour some money into development, you've got to be concerned about maintaining that moat. And so that's one of the things that is super important that we look at. So on the market, again, this is super important. So we're looking for a unique market that can support a revenue opportunity of $50 to $100 million, right? And so ideally, that is a $500 million or $1 billion market. So the reason that's important is that over time, even if you're the first to market, even if there's no one else in that market today, and you've created your own unique market, over time, we found that companies can really only hold more than, call it 20% of the market, right? It's really difficult to maintain more than 20% of a market as the market matures. Well, in order to be a company that generates $50 to $100 million, right? If you're serving a $100 million market, well, you're not going to be big enough to move the needle for a major strategic buyer, or move the needle for somebody who's a potential investor who's looking to get, call it 3, 4, 5 times their invested capital, right? So the market's got to be big enough to support you as a company growing to a meaningful size. So on momentum, and momentum is probably one of the most important of these 10 factors that we look at. It's how fast are you growing, right? What are the indicators that the company's offerings being accepted and can scale? And one of the things that we find is that a lot of times companies will, they'll come to us and they'll say, hey, we're at an inflection point. And we have, we've been growing like this, but all of a sudden we're gonna grow like that. And when you are looking at investment, or when you are looking at being acquired by a larger strategic, right? You want to be up here, not right in here, if you will. And so, but you don't necessarily have to do that from a revenue perspective, right? It's great if ARR has grown from $1 million to $5 million over the course of 2 years. You're doubling every year, right? That's great. But momentum indicators are not just revenue based. They can be bookings based, right? You've booked revenue, so you've doubled your bookings. That gives somebody comfort that the momentum's there in the future. Another thing is how big is your funnel, right? So we spend a lot of time looking at funnel methodology and funnel metrics. My funnel has grown 100% year over year, and I vetted it, and we're being realistic, and we're not just throwing the entire kitchen sink, but my funnel has doubled. That's a momentum indicator, right? And so we don't just think about momentum as, hey, revenue's got to be doubling. There's other ways to demonstrate momentum when you lack the revenue. So that's momentum. Management, a couple things, right? So does the company have the team that can scale the business and avoid pitfalls? It's hard growing from $1 million ARR business to a $5 million ARR business, and it's hard growing from a $5 million ARR business to a $10 million ARR business, right? What's the team look like? What's the team? Who are their advisors? And do you have a strong bench? And the bench is particularly important. So for growing companies and companies that we take to market, if I'm taking Roger Christopher's company to market, what I don't want is to be selling the Roger Christopher show, right? Particularly if Roger wants to exit and hit the beach after he sells his business. So having this next level of management below the senior management team and being able to identify who is the person who is going to take over and run this thing and continue to drive the business forward. That's super important. So that's what we look for in management. And then lastly is the financial model, right? And do you have a pressure tested set of credible financial models that are going to support a premium valuation? And we help our clients build this, right? And so what you want to be able to do is when you sit down with a buyer or you sit down with an investor, you want to be able to have solid supports for your models that they're going to pressure test it, and they're going to beat it up and try to understand your assumptions and understand why your assumptions are your assumptions, what the rationale is behind them. So having these models is super, super important. And we just got a question. Does high renewal rate also help justify the full counting of the momentum, or do you place this metric under a different M? So renewals, retention, that's a support for momentum. That's where we would categorize it. So high renewal rates would be a good support for momentum. All right, thank you for the question. All right, so I think, unless I'm mistaken, we've gone through the 5 Ps, we've gone through the 5 Ms. Let's talk a little bit about how we optimize value for our customers. And I will take a break, have a sip of water, and turn that over to Roger.
Yeah, thanks, Alan. So in terms of value optimization for our clients, we think in terms of 3 categories. So there are baseline valuation metrics, the refined or sweet spot valuation metrics, and then there's premium valuation metrics. Now, each of these metrics has its own set of characteristics and dependencies, as I'll go through. So getting a buyer to pay a premium valuation right off the bat, it's not a natural act, right? There are things that need to occur. There's an intense amount of preparation on our part with clients, and an intense amount of arming the buyer organizations with the right information so that they could build business cases. All that being said, usually the starting point for a buyer, even though they might know differently internally, is that they'll usually come in with a set of baseline metrics that are dependent on some of the analyses that we just showed you before, meaning they might look at, a set of publicly traded companies, or a set of, or a limited set of recent M&A transactions. And they might cherry pick 1 or 2 that kind of sort of looks like our client, and they'll say, hey, based on all of the market metrics that we're seeing, we feel that the valuation is X. And it will typically be a median or slightly below median type exercise in that case. This type of analysis is usually pretty mechanical on the buyer's part. We know that internally they would have gone through the process that I mentioned earlier, which is they would have looked at the forward potential of the business, et cetera, because we arm them with that data when we talk to them on behalf of our clients. So we know that they do that. We know that they look at synergies and some of the other elements that I'll talk about here soon, but they'll typically start with, a more mechanical type process and justify an initial set of offers. What we then do before we even go to, and these are things that we do before we go to market with our clients, by the way. What we'll do before going to market is we'll start to look at how can we refine the universe of transactions and publicly traded companies, et cetera. How can we refine that in such a way that we're really honing in on transactions that look like us, our positioning, et cetera, et cetera. And this is the beginning of us proving out, that our clients are above median companies, right? We're trying to move buyers from baseline metrics. And so what we do is we work, with our clients. We're very knowledgeable in our market sectors. So what we'll do is we'll take a set of, if there's a broad set of M&A comps, we'll hone in on a specific set that tend to look like, our clients, right? And by looking like our clients, we mean in terms of market position. It's not just, industry participation. It's markets. It's end markets of participation. It's growth rates. It's IP. We look at a number of quantitative and qualitative aspects, and we hone in on a targeted list of M&A companies that we think are most relevant for our clients. So with this targeted approach, obviously our goal is to kind of position our clients towards the top quartiles of any analyses, and this is part of how we do it. From a premium perspective, to get to premium valuations, it's really about moving the buyer from beyond even looking at comparables. It does incorporate comparables and previous transactions, but then there are other elements. This is when we hone in on things like potential synergies. Now, a buyer will never give up 100% of whatever synergies they're contemplating, but we know that all buyers are going to create a synergy model where they know the elements from both a costing perspective and a revenue perspective where they could derive value from our clients. And again, we arm them with enough information for them to basically create some of those synergy models. And we expect credit for at least a partial set of aspects therein. The next thing that we do is we arm them with various positioning elements. So it's the forward-looking TAM, like Alan mentioned. To the extent we do all this work up front, so to the extent that our bottom-up TAM analyses show 500 million plus, a billion is better. We're able to credibly show models in which 3, 4, 5 years from now, with the right set of resourcing, et cetera, that our clients could credibly build a 50, 75, or $100 million plus business. And that's the exercise where we paint the picture for them to socialize internally that this is a business that could easily be $100+ million business or more in the future. And that starts the exercise of them thinking about discounting it back and giving our clients a healthy and premium valuation today, while also creating value for them internally post-transaction. Next slide. So what are some of the software valuation drivers? So clearly not all SaaS companies or not all technology companies are created the same. So revenue mix is hugely important. The rule of thumb is that if a company is, let's say, 70% SaaS, meaning like 70% SaaS or subscription licensing, with 30% services that are in support of implementation of those software products, companies will generally get credit for 100% of that revenue stream being ARR or annual recurring revenue. You go a revenue mix where, as the mix gets beyond 30% of services, buyers tend to start thinking about valuations from a sum of the parts perspective, where they'll start valuing the services very, very differently than how they would value the SaaS piece. So revenue mix is critically important. And again, the target would be to, have a profile that is 70% or more of SaaS, recurring revenues. Size and momentum. If you take two otherwise identical SaaS companies, same growth rate and same profile, same industries, but if one is, 3 times the size of the other, just the sheer scale of the larger company will garner a higher multiple of revenues. And the thinking there should be intuitive, but it's all about the larger SaaS company is significantly de-risked, right? As you go from year to year, there is a large stable revenue base upon which you're building. So it's heavily de-risked as opposed to the smaller companies. So certainly size and momentum is extremely important. And as Alan mentioned before, one of the key metrics in terms of rule of 40 companies is to kind of critical mass is around 10 million of ARR that's where we really see some of these a high correlation with some of these Rule of 40 metrics. Market positioning and momentum, that's something we talked about. An uncapped market where, there's by uncapped, it's really in air quotes, really. Uncapped for us means a unique bottom-up market opportunity for our clients that's north of $1 billion. That's what we mean by uncapped. Not that you can't get premium valuations with smaller numbers, but certainly $1 billion plus is usually a key, because we're selling these to larger companies with, they want scale or an ability to build, large organizations into the future. Buyer synergies, something that we talked about. So these are kind of like the core areas of what drives valuations, within individual companies. We saw earlier the wide variety of SaaS metrics. These are some of the nuances on an individual company basis that kind of moves the needle in one direction or the other. Next slide. So how do I get, the 10x revenues? Quite often we will get prospects and they'll say, hey, we saw that so-and-so company, like for instance, we sold Pinnacle 21 last year for 310 million. That was a, north of, 18 times revenue deal. And so quite often we'll get prospects who say, hey, how do I do that? How does that happen? I'm very similar. How do I do that? So a lot of it has to be, this is where the P5M process really, really shines. And it's all about the positioning, the looking at the model, the market, how large the market is, the moat, all of those things come into play. And it's really, the bottom line is it boils down to doing the preparation work ahead of going to market. Like, we know what buyers are looking for. We know the characteristics of premium companies. And so the trick is to reverse engineer that. And while you might not score highly in every single element of our P5M process, the goal is to kind of really be optimized across as much of that as possible. So yeah, it's really about establishing the P5M process well in advance of considering an exit, because it does take time.
The dreaded,
Alan, you're on mute.
The dreaded unmute. So we've got just about 10 minutes left. So I do want to the extent that anybody has additional questions, feel free to bring them. So we did get a question from Jason, and his question is, in a model where, and we see this a lot, in a model where or different variations of this, in a model where SaaS is prepaid via a credits or token system that let the customers pay what they want and buffer ahead of time when they have money. So examples are at AutoCAD, at VMware. How does that affect the metrics computation? And so from my perspective, we see a lot of companies that don't fit neatly into subscription revenue buckets, right? And so I think what you want to try and do with a company like that, and Roger, I'd love your perspective as well, is focus on, okay, logo retention, right? Are these contracts, are they annual contracts? Are they multi-year contracts that are renewing, right? And so by focusing on logo retention, you can say, hey, we're keeping the customers that we have, right? You can focus on lifetime value of customers, right? To get a sense for, are my metrics around lifetime value and customer acquisition costs, right? Are those metrics strong? Customer payback period, right? Even in a situation where people are purchasing credits that they're using over time, you still should be able to get a good estimate of lifetime or of payback period. So, I mean, those are areas that I would focus on. The thing that gets a little bit tricky, or can get a little bit tricky, is net retention or net revenue retention, right? If a customer is spending, $10 million or $1 million this year and $500,000 next year and $1 million the following year, that gets a little bit distorted and can get distorted. And so what you need to do is, create a good narrative. And this is why MD&As exist in SIMS, which is an MDA's management's discussion and analysis. It's why MDAs exist in SIMS, to be able to say, hey, look, here's what's happening with our revenue. Here's why we're showing strong momentum. Here's why we're able to retain customers, and sort of focus them on that and focus them on the metrics that are more relevant than others that might not be. Roger, anything to add on that?
Yeah, really, I'll just really quickly, as I think there are some other questions that came in. The bottom line in the case where companies are prepaying upfront and then maybe drawing on that prepaid over time, what buyers will be looking for there is the recognized revenue perspective, right? So the prepay is one thing, but it's really the shape of, what that recognized revenue stream looks like, over time. That will be something that buyers, hone in on. And if to the extent that it's showing something that's monotonically increasing, that's positive. If it's more volatile, then, that's going to be cause for concern. But that's my only addition to that point, Alan.
Okay. And then another question that came in from Jamie. So outside pure SaaS tech in industry verticals such as healthcare services, how relevant are some of these valuation concepts? E.g., do valuations revert to EBITDA multiples rather than revenue multiples? Well, I would argue that these concepts are still important, right? Momentum is still going to be important. Moat is still going to be important. Management is still going to be important. Position is still going to be important. So, a lot of what we're talking about in terms of SaaS metrics and things like that are relevant to the space. But I think a lot of these concepts around the framework that we have to figure out where valuations can lie, and it might be, they may approach it differently, right? For a SaaS company, you're valuing it based on ARR, but for a healthcare services business, you may be focusing it in order to have the discussion on a multiple of EBITDA, but whether or not you're an 8 times EBITDA business or a 15 times EBITDA business, I think depends a lot on what we're talking about here. All right, cool. And we got about 5 minutes left. So, just to hit this slide, driving a premium valuation, this isn't a transaction process, right? This is how we approach the transaction process. So the external valuation, the market conditions are going to form the foundation of your valuation. What do companies trade for in HR technology? Or what do companies trade for in life sciences software, right? Those are a couple areas that we spend a lot of time, right? So those are market conditions and external valuation metrics. But what we do from a transaction perspective is try and drive folks up the valuation curve, right? What is company specific that is really interesting? And then on the transaction process, running a really tight process is something that we're very focused on, and it's perfect prep and perfect process is what we focus on from an M&A perspective. All right, and so we are getting close to the end here. So how can I get started? So if you're interested in learning more, we offer detailed information that we'd be happy to share with you. So we've got this presentation around the P5M methodology. We have a SaaS quarterly that we distribute that we're working on right now for Q1. And we've got other specific reports on verticals such as healthcare services, life sciences software, which is a report that Roger puts out. We do an HR Tech quarterly, which I put out. And for those that are interested in A, getting on the list, or B, talking about the industry with us, we're happy to do it. We're always happy to support the community and and for those who are involved with PEC, we're happy to invest our time for our friends. So if anybody wants to apply these wants to apply the methodologies described, happy to help you get started. My email address is on there, alan.bourne@fairmountpartners.com. Roger's is on there as well, Roger Christopher at fairmountpartners.com. And we're again, always happy to have a call, always happy to help. So that's the end of our formal presentation. A couple of reminders. Dean mentioned at the beginning, we've got a forum coming up. So forum is April 27th. And if you haven't signed up, please do. It's at Penn State Great Valley this year. There's always really, really good content. And also it's a really good networking opportunity. And there is an open bar. And I am responsible for the open bar. Heidi will tell you and Dean will tell you. So come and we'll have drinks on the 27th. Also, there is a demo pit that is that many of I think it's a dozen early stage local companies are participating in the demo pit. So you can come out and support them. And then also enterprise awards are coming up in May. So we're super excited about all that. So that's it for the show. Hopefully you enjoyed it. Hopefully you got something out of it. I do want to thank the PAC team for giving us an opportunity to share these materials with you all. And Roger, thank you for joining us. I certainly appreciate it.